Warren Buffett, the Oracle of Omaha, is known for his wisdom in the world of investing. One of his most famous quotes is, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This simple yet profound statement has been the bedrock of Buffett's investment philosophy for decades. But even the most steadfast investors make moves that catch the market by surprise. In the second quarter of 2024, Warren Buffett and his company, Berkshire Hathaway, made some significant adjustments to their portfolio. Perhaps the most shocking move? Buffett sold a sizable chunk of Apple stock. That's right, the same Apple that had been the crown jewel of his portfolio for years. But why would Buffett, a man known for his long-term commitment to the companies he invests in, decide to part ways with such a massive portion of Apple? In today's video, we'll dive deep into the rationale behind this surprising decision and explore the 5 intriguing stocks Buffett chose to buy instead. By the end of this video, you'll not only have a clearer understanding of Buffett's current investment strategy, but you'll also gain insights into the stocks that have captured his attention in 2024. So, let's get started. First, let's set the stage by examining Berkshire Hathaway's recent 13F filing, a document that provides a window into the company's stock market moves. This report is eagerly awaited by investors around the world because it offers a glimpse into the mind of one of the most successful investors in history. And this time, the filing revealed some eye-opening changes. One of the most notable moves was Buffett's decision to sell approximately $50 billion worth of Apple stock. To put that into perspective, this sale reduced Berkshire's stake in Apple from $174 billion at the end of 2023 to around $84 billion. While Apple remains the largest holding in Berkshire's portfolio, its share has dropped from 49% to 30%. This significant reduction has left many wondering, why now? But before we delve into the reasons behind the sale, let's talk about where that capital was redirected. Despite being a net seller, Buffett didn't just pocket the cash and sit on the sidelines. Instead, he reinvested in 5 different companies, each with its own unique appeal. Let's break down these 5 new additions to Berkshire's portfolio. The first stock Buffett added is Ulta Beauty, a company that might seem a bit out of left field for someone who usually sticks to more traditional industries. But when you look closer, it starts to make sense. Ulta Beauty is the largest specialty beauty retailer in the United States, with a vast selection of products ranging from cosmetics and skincare to fragrances. What sets Ulta apart is its unique business model, which combines retail stores with full-service salons, creating a one-stop shop for beauty needs. With over 2,300 stores across the country, Ulta has established a strong presence in the beauty industry, a sector known for its resilience even during economic downturns. Buffett's team purchased approximately 690,000 shares of Ulta, valued at around $26 million. While this represents just a small fraction of Berkshire's overall portfolio, it's a strong endorsement of Ulta's business model and growth potential. The beauty industry has shown remarkable stability over the years, and Ulta has successfully adapted to the shift towards e-commerce, growing its online presence while maintaining robust in-store sales. This combination of a solid physical footprint and a growing digital presence likely aligns with Buffett's long-term investment strategy. The second new addition to Berkshire's portfolio is HEICO Corporation, a company that might not be as familiar to the average investor. HEICO specializes in manufacturing technology products for the aerospace, defense, and industrial sectors. Known for its high-quality products and innovation, HEICO has become a key supplier to both commercial and military customers. Berkshire acquired roughly 1 million shares of HEICO, valued at approximately $185 million. This investment represents about 0.07% of Berkshire's total portfolio. HEICO's focus on aerospace and defense gives it a strong growth trajectory, especially in a world where global tensions and defense budgets continue to rise. The company's products are critical to the operation of aircraft and other high-tech equipment, making HECO an indispensable player in its industry. What likely attracted Buffett to HECO is its consistent profitability and its position in a sector with high barriers to entry. The company's ability to innovate and meet the evolving needs of its customers fits well with Buffett's preference for businesses with a durable competitive advantage. But Buffett didn't stop at just adding new stocks. He also increased his stakes in several companies already in Berkshire's portfolio, signaling continued confidence in these businesses. One of the most significant moves was the addition of 7.2 million shares of Occidental Petroleum, bringing Berkshire's total to 255 million shares. This makes Occidental the sixth largest holding in Berkshire's portfolio, representing 5.8% of the total, up from 4.8% in the previous quarter. Occidental Petroleum is a major player in the oil and gas industry, and Buffett's interest in the company dates back to a $10 billion investment in 2019, where Berkshire received 100,000 preferred shares with an 8% dividend and warrants to purchase 83.8 million common shares at $59.62 each. During the second quarter of 2024, Occidental's stock dipped by 5%, providing Buffett with an opportunity to buy more shares at an attractive price. This move underscores Buffett's long-term view on the energy sector. Despite the global push towards renewable energy, oil and gas remain essential to the world economy, and companies like Occidental are well-positioned to benefit from ongoing demand. Additionally, the preferred shares offer a steady income stream, which is another reason Buffett might be keen to increase his stake in the company. Another significant addition was Berkshire's purchase of an additional 1.1 million shares of Chubb Limited, a global insurance company. This brings Berkshire's total holdings in Chubb to 27 million shares, valued at $6.9 billion, making it the ninth largest position in Berkshire's portfolio, representing 2.5% of the total. Insurance has always been a cornerstone of Berkshire Hathaway's business model, providing a reliable flow of cash through premiums, which Berkshire can then invest in other opportunities. Chubb is one of the largest and most respected insurers in the world, with a broad range of products and a strong presence in both personal and commercial insurance markets. Buffett's decision to increase his stake in Chubb likely reflects the company's strong fundamentals and its ability to generate consistent profits in an industry where scale and risk management are key to success. Lastly, Buffett added to Berkshire's holdings in Liberty Media Corporation, specifically its Liberty Sirius XM Group C shares, LSXMK, and Liberty Sirius XM Group A shares, LSXMA. Additionally, Berkshire increased its stake in Sirius XM Holdings, SIRI. These combined holdings now represent 0.56%, 0.28%, and 0.14% of the portfolio, respectively. Liberty Media has been a long-standing investment for Berkshire, and these recent additions show Buffett's continued confidence in the company's strategy. Liberty Media recently announced a plan to simplify its structure by combining Liberty SiriusXM with SiriusXM Holdings, creating a more streamlined entity. This restructuring is expected to unlock value for shareholders, and Buffett is positioning Berkshire to benefit from these changes. Now let's circle back to the question that's been on everyone's mind. Why did Warren Buffett sell Apple? While Buffett hasn't provided a detailed explanation, there are a few possible reasons that could have influenced his decision. First, Apple's stock price has surged in recent years, and by selling a portion of his stake, Buffett was able to lock in significant gains. This move also allowed Berkshire to increase its cash reserves, which reached a record $76.98 billion at the end of Q2 2024. Having a large cash reserve gives Berkshire the flexibility to take advantage of future investment opportunities as they arise. Another factor could be taxes. With the passage of the 2022 Inflation Reduction Act, Berkshire is now subject to the Corporate Alternative Minimum Tax, AMT. By selling some of its stock portfolio holdings, including Apple, Berkshire can increase the amount of taxes it pays in a given year, potentially avoiding higher tax rates in the future. Lastly, Buffett may be anticipating changes in the corporate tax environment. By selling some Apple stock now, he could be positioning Berkshire to pay taxes at the current rate rather than a potentially higher rate in the future. Warren Buffett's decision to sell a significant portion of Apple stock and reinvest in other companies may seem surprising at first, but a closer look reveals that it's all part of his long-term strategy. Buffett is not just looking for quick wins. He's building a portfolio of companies with strong fundamentals, long-term growth prospects, and the ability to generate consistent returns. His moves in 2024 are a reminder that even in a rapidly changing market, the principles of value investing remain as relevant as ever. If you found this breakdown of Warren Buffett's latest investment moves insightful, make sure to give this video a thumbs up. And if you're interested in more content like this, don't forget to hit that subscribe button and turn on notifications so you never miss an update. Thanks for watching, and we'll see you in the next video.